Hello, my name is Olga, and this is my channel about startups. And before we start a new topic today, talking about shares, I would like to ask you to like my videos, subscribe, and share. Thank you. So, different kinds of shares, what does it mean? In a startup, different players can get different kinds of shares. There are two main kinds: common shares and preferred shares. And the main difference between the two is the amount of rights you get when you get these shares. If you own common shares, you have less rights, obviously, than when you own preferred shares. Common shares are usually issued for founders and employees, and preferred shares are usually issued for investors. And at at the moment of round A, you can have preferred round A shares. And then at round B, you will have preferred round B shares, and the rights will be different. The later, the bigger the amount of investment, etc., the more risk, the more rights an investor wants. So that's about shares. There is one thing that is also discussed in term sheet concerning the rights, and it's called liquidation preferences. What does it mean? When is it discussed at all? Liquidation preference is discussed when a startup is going to have M&A opportunity, or will be liquidated, go bankrupt, go south, for example. And that's something an investor wants to protect itself from. So liquidation preference is basically how much money will the investor get in these two cases. And there are two main options, or two main descriptions of liquidation preference. This is the amount of money. It's either 1x, 1.5x, or 2x, and participation and non-participation. What does it mean? Let me explain. So basically, 1x, 2x, 1.5x is about how much money will the investor get back, depending on its initial investment. X is the amount of investment, and then it's multiplied by 1, then an investor will get back the same amount of money. Let me give you an example. I invested 10 million and I have 1x liquidation preference. It means that when the company is going to be bought by someone else, I will get back my $10 million. If it's 1.5, then I will get $15 million. If it's 2x, I will get $20 million, etc. And that is something that is stated in term sheet. Second part is either I will participate or not participate further after I get my money, and what is left, will I participate in the distribution? For example, the company, the acquisition price is 40 million. I got back my 1x, my 10 million, 30 million left to be distributed among founders and employees if I have non-participation clause. If I participate, then based on my amount of shares in the company, for example, I invested 10 million and it gave me 20%, I will participate in distributing the rest. Let's say 30 million is the rest, and I will still take 20% of that, which is 6 million. So in total, I will get back my 10 million plus 6 million because I participated in distribution. So liquidation preference is discussed in term sheet as a clause that is very important for investors because they want to protect themselves in case company goes south or there is an M&A case. And that is something you as founders will need to negotiate with your investors early on. Thank you for your attention. Please write your comments, subscribe. Bye.